Morning, ladies and gentlemen, fairly. I am Georg von Wyss. I am a portfolio manager at BWM. With me is Urban Mueller, who does client relations. We are a small value firm in Wielen by Wollerau. We've been around for 25 years, and we do value investing, as I hope you know. And what we're going to talk about today is just give you a quick introduction of ourselves, then talk about values performance patterns over time, give you some arguments for why value is an absolutely valid and interesting investment style, even though it's been having a hard time, and then give you a bit of an outlook, in particular through the lens of how our funds are positioned. So let me start quickly with the introduction. Here you see the entire team. There's only 6 of us, but 4 of us do securities analysis and portfolio management. That's the top row. And then Urban and our colleague Daniel Jordan take care of everything else. The team has been together like this for 20 years. The business has been around for 25, and we've been together for at least 20. 5 of us. Urban is the new guy. He's only been around for a year and a half, but as you know, as you will tell shortly, he is a value man through and through, and therefore fits in perfectly. We launched the Classic Global Equity Fund, our flagship, in 1997. Have always managed it as a value fund. Our goal is to accumulate capital in the long term, so we don't pay much attention or we don't try to beat the market on a short-term basis. Obviously, we pay attention to our performance, but our goal is not to be better than the market at the end of the quarter or the year, but to be better over the long term. And we're fully independent, so the company belongs to the 6 people that you saw just now, and therefore we are free to do as we like in terms of investments. Obviously, we pay attention to what our clients want, but we don't have a boss breathing down our neck saying, you have to get better, otherwise you'll get fired. So let me give you the punchline of our talk already, why value works over the long term. It's really the fact that arbitrage works in the markets. But in the short term, of course, it doesn't. And you remember Ben Graham's image of Mr. Market, who's always willing to give you a price quote, bid and ask every day. He'll come and offer you bid and ask, and sometimes he's exuberant, and sometimes he's depressed, and his quote will be high or low depending. But he'll come back the next day every day. He's never offended if you don't trade with him. So to take that analogy a little bit further, Mr. Market tells stories. Was that me?
Nope, that was my hand.
He exhibits psychological biases. As you know from behavioral finance, there's a whole bunch of traps that we investors can fall into, and Mr. Market falls into them constantly. So he's always overexcited or he's excessively depressed about things. He tends to ignore long-term valuations, but he likes momentum a lot. So the question he doesn't ask is, let's say all of us here in this room were rich enough to buy Nestle or Apple. What would it be worth to us over the long term? When you start to think of a company in those terms, you're not thinking about next quarter's earnings, you're thinking about its long-term earnings potential. It's what we do, what value investors do, but it's not something that Mr. Market does so much. And then, as I said before, if you're subject to career risk, you're unwilling to take some of the large bets that are required in value investing, or the large bets to go against the market, which may not work out. And as a result, you just don't do it. But over the long term, none of this is true. Most shares are correctly valued most of the time. So we believe in a weak form of market efficiency. The markets do a good job of pricing assets, and we want to take we want to benefit from that mechanism by holding cheap stocks and waiting until things go in our direction. To that extent, we are focused on process and process. We're very process-oriented at BWM. We try to cross all the T's and dot all the I's when we're valuing companies so that we don't miss anything that then comes back and gives us bad performance on that individual stock, which of course doesn't mean we don't have bad performance on individual stock. We do. Things go against us all the time. We miss things and companies have bad luck, but you try to minimize that with thorough research. So here's the chart that has allowed us to keep the faith in the last 8 years, which have been terrible. This is the Pharma French data that you can get online. Ken French has a website where he publishes it. He divides the world into, or he and Eugene Fama divided the world into cheap and expensive stocks, and then they took those two halves and divided them into, it's large and small stocks. They divided the world into large and small stocks, and then they divided those two halves into cheap, in between, and expensive. So you have 6 portfolios. I'm showing you 3 of those portfolios: small cheap stocks in blue, big cheap stocks in green, then the market, which is not one of the portfolios, but we have the data for that as well, that's in orange, and then large expensive stocks. So the stuff that's done great in the last few years. That's the bottom line. And you can see the magic of compounding on one hand. Just a few points of annual performance difference per annum makes a huge difference in how rich you become after 70 years. This data starts in 1951. It uses price to cash flows to sort the portfolios. If you look very carefully, you see that large, expensive stocks have done better than the two value portfolios in the last 8 years, or starting in 2015. But that's exactly the point. You have to look very, very carefully to see that. It's not normal. The normal pattern is, especially for small caps, but any value stocks, to outperform the market significantly over time. Now, that does not mean that you don't have terrible periods, as we've said before. We show you here a chart with the same data, and in the green bars, we show you all the drawdowns of more than 10%. And so we see a couple of things. Number one, we've just been through the worst period ever. We've had very large drawdowns since 2015. But we've had periods of big drawdowns that lasted for what feels like forever. We've had those before. We had them around the year 2000 when everybody was going crazy about the internet. We had them in the early 80s. We had them in the oil crisis in the beginning. So it happens all the time that value goes through these patches of very long underperformance. And remember, these are multi-year periods. So those are the periods where people then give up on the style and throw in the towel and all that sort of stuff. If you look at the monthly return distributions of value minus growth portfolios, so we're comparing small cap value against small cap expensive, small cap or large cap value against large cap expensive, and we're just doing the monthly outperformance or underperformance, and then you do a histogram of that, you get a pretty normal distribution, and we've cut off the top of it here because you have some pretty big tails. It's normal sort of in the middle, but the tails are actually very, very large. So you can have some awful months relative to growth, but you can also have a lot of wonderful months. And the outperformance in value actually occurs because on the mean on this distribution is just a little bit to the right of 0. There's an outperformance with small caps of 0.4% per month and of 0.23% per month for the large caps, which of course annualizes to some fairly significant numbers that we've seen before. But the point is, if you just look at the distribution itself, you don't really notice that value is better than growth, but it is. 58% of the months and 54% of the months for large caps are actually months of outperformance for value versus growth. But again, those volatility tails are big. If we take those monthly returns and we graph them over time, a couple of interesting things come out. Number one is you don't really see that value is better at all. This just looks like, it just squiggles around randomly, it looks like. But you do notice a few periods here, stagflation in the 70s, and then around the year 2000, where those really big excess returns or underperformance in either direction, so the super outperformance, the super underperformance, they tend to cluster together. So you go through these periods of huge volatility. So you have, for example, here, value was just absolutely awful in, this must be in late 2000. But then it had a couple of wonderful months to compensate. So if you see a particularly bad month for value, that doesn't mean you won't have a particularly good month to follow afterwards. What's interesting too is the last period of this long period of underperformance of value is actually quite a quiet period. We don't have we don't have these wonderful months. We don't have terrible months. We just don't have as many good months as we normally do. So the reason value underperforms here, if you're just looking at it in these terms, is it just didn't have enough good months, not as many as it normally does. But the point of all of this is to some extent is you can't really time when value is going to outperform that well. It's hard to look at this distribution and say, okay, this is when I get in, this is when I get out, which for us is an argument to just stick with the style and tough out the bad periods. Now, of course, valuation matters even for value, and that's what this chart is trying to show. We're showing you the degrees of undervaluation sorted into 5 categories, and the bottom and we show you the performance in the subsequent 1 year, 3 years, 5 years, and 10 years. So obviously, when value stocks are really, really cheap, it's more fun to own them over the next 1, 3, 5, and 10 years. They do better. But even if you buy value when it's relatively expensive, you can expect to make money as a long-term investor. You'll still have outperformance. You may not, however, in the short term, which, as we've said, doesn't interest us, but may be relevant to you. The trouble is knowing where you are in this. Obviously, figuring out the valuations isn't that hard, but it's not so easy to deduce from this that it's now time to get out of value and sell, because we've had periods where value did well even after all of that, as Urban will show you. For those of you who are worried about inflation in particular, this extremely interesting chart, which we've borrowed from our friends at GAM, it sorts inflation into 5 periods. They're not equally large. So we have the periods when inflation was lowest, that's 15% of the total, then when inflation was highest, so above 6%, that's another 15% of the total observed periods. These are annual periods, and everything in between. And what we see from this is that, and then we show you the excess returns of the data that we had before, the Fama-French data. So again, small cap growth in blue, large small cap value in green, and large cap value in gold. And then large cap growth, this light blue. And value consistently does better than those in every inflationary phase. But it's especially interesting when inflation's super high. We actually make money as a value investor, whereas as an investor in expensive stocks, you had a serious risk of losing money. But the sweet spot, of course, is when inflation is somewhere between 0.6 and 6.1%, according to the historical data. So normal inflation means normally value outperforms. It doesn't outperform, and that's the recent data, obviously, is reflected here. It does poorly when inflation is very low, as we have just experienced in 2015. This is everything about financial repression, where you were happy to own the large cap growth stocks and not small cap value. Just for the fun of it, here's the time series of the data that we've been showing you all along, from 1967 to 1981, so capturing that large period of high inflation. That's the blue line here, the CPI. The reason we graph it like this is we show you that with value, with both large and small cap value, you actually got richer. In real terms, you made money, whereas you did not with the market on the whole in inflationary periods. In the beginning, that wasn't so clear, but in the end, it was very clear. So anyone who's bearish about inflation in the room, we're trying to give you another argument why you should invest in value funds at this point. All right. Let me hand over to Urban, who's going to show you where we stand today.
Right. So good morning, everyone. Thank you for being here. George basically took the deep dive. He went all the way back to 1926. I'm trying to stay a bit closer to the surface, the more recent period. And on this particular chart, I have taken the same data that George showed, except that there is no grouping by size. Basically, the Pharma French data is only grouped by expensiveness in 5 quintiles. The cheapest are labeled value and the most expensive growth, all the way back on the left to 1951. And then here on the right-hand side, that's the zoom to the more recent period. We rebased the numbers to start in 2006. And you see what George has already referred to, which is that basically since 2006, value at first was neck to neck with growth, and then in 2015 it basically flatlined. So what's going on? Certainly we don't just take the long-term series and say, well, it's worked in the long term, it will work again in the future. We try to get a better understanding of what's been happening. So first off, if you dive into the data of what's happened since 2015, most of you will be familiar with the fact that performance, particularly in the US, but given the market cap of these companies, has been driven by large cap tech related firms. Listed here, they made up a huge percentage of the outperformance of growth since 2015. Also, what hasn't really worked in favor of value was the interest rate environment, as we've already seen in the data before. But money was so cheap that effectively future cash flows were valued as if you'd get them today, even though you still had to wait for them. With interest rates being at zero, effectively it means discounting doesn't do a whole lot to future cash flows. And then certainly it also led to some risk-taking. People had to chase for yield, for return, and went into asset classes that were offering that. And there was momentum that built up, at least anecdotally. That's one of the reasons why we've seen this outperformance. More specifically to Europe, and we'll focus in on that a little bit, there was a flight to quality, not necessarily out of all types of value stocks, but certainly out of the small, volatile stocks. We saw it in our portfolio that simply by association, the closer you were to Ukraine, the more you got hit in 2022. And that had nothing to do very often with the quality of the company. So here are some reasons, but we wanted to go deeper in terms of the data. And we've taken some of that from my former colleagues at GMO. What they've basically done, they've done a return decomposition. What you can do is you can mathematically decompose equity returns into 3 terms. There's a change in valuation, there's a growth component, which is basically how much earnings you're generating, and then dividends. That's a mathematical identity, which gets a 4th term once you aggregate data into portfolio level numbers. So once you have a value and a growth portfolio, there's a rebalancing term, because every year what you'll do is you take out the most expensive value stocks, those that have appreciated in valuation, they go into the growth category and vice versa. And that will be a component of your portfolio return. You can do this sort of analysis also for return differences, and what is of interest to us here is the difference in return between value and growth. And they have done it, and we show it here for 2 time periods. So you have from 1983 to 2006, and then laterally, I'll show you 2007 to 2021. And this is the typical historical pattern of return decomposition for value versus growth. What you see is that actually most of the return you get from value investing is from buying stocks that came out of the growth universe and from chucking out stocks once you rebalance that have become more expensive and put them in the growth universe. Those stocks tend to underperform, those that you chuck out. Quite a bit of that, almost by definition, is offset by the fact that value companies have a lower growth component than growth companies. So the earnings growth of growth companies, by definition, is higher. And the two of them almost offset each other, but not entirely, because value stocks tend to pay higher dividends. And for this particular period, what happened is that value stocks relative to growth stocks got somewhat more expensive. These are annualized numbers, so for the entire period there, 83 to 2006, per year you were earning pretty much in line with the very long-term data, 5.5% more with value than with growth stocks. So that's the decomposition. Thank you for bearing with a couple of formulas here. What's fascinating is the comparison with the latter period starting in 2007. Fascinating in that actually not much has changed. Value investing, and that is very important, has actually worked in terms of its main components. Rebalancing worked just fine. It wasn't quite at the same level. Growth actually for value was a little bit higher than in the previous period, but it was very comparable to what you saw before. And value stocks continue to pay higher dividends than growth stocks. But effectively, what's been happening, and this is why this return decomposition is so interesting, is that growth stocks got much more expensive relative to value stocks. So the gap opening up, and this is what I'm showing here on the next page in terms of valuation, these are PE valuations for index numbers. The gap opening up between the valuation of growth on top and the valuation of value at the bottom is really the major driver of the return difference between value and growth. So where we find ourselves right now is with a huge valuation gap. And it actually is interesting to compare the United States with Europe, because in Europe, there has been quite a bit of a convergence back together. Not quite, the gap is still high. But also in the US, what you see is the actual level of valuation of value is at historically sort of normal levels. Value isn't particularly attractive in the US. It isn't particularly unattractive either. And then in Europe, though, both the gap is much bigger and the level of valuation of value is much lower. So value per se is really attractive, which we find interesting because in our daily business, we don't really care about index level numbers. We come from a frog perspective, bottom up, and where we find the opportunities right now is in Europe. That's where, on a valuation basis, you find interesting opportunities. So at least to us, it's reassuring when digging into the numbers that there is a very reasonable explanation as to why value hasn't outperformed. And the really fascinating things or interesting thing from our perspective is that valuations cannot diverge ever more. There is a gravitational pull. At the very least, we would expect valuations between value and growth to stay the same. But more likely, at least we think, is that valuations eventually will come in. So that's the bigger picture. Now I take a deep dive into our particular portfolio. And the portfolio that we hold tries to invest not just in cheap companies, but in cheap companies that actually generate value, that create value for the shareholders. that are not value traps. And maybe afterwards in the Q&A, we can talk a little bit about what value traps might be. But for us, here we show an example of a stock, and we calculated so-called Buffett PE, which is the change in book value per share plus accumulated dividends from the time of purchase to a couple of weeks ago when we handed in the presentation to FINANZ'. And what you can see for this machinery manufacturer, Andritz, Austrian company, pretty close to the Ukraine, it generated per annum 22.1% of value on this particular pretty simple definition. But the company actually generated a lot of value, and we find a number of really interesting firms like this who do that. So in theory, because we haven't really talked about our investment approach, but our investment approach is effectively to buy companies that are, at time of purchase, 40% undervalued. So we buy at a discount of 40%. So what we'd expect in terms of the stock price is not only for it to keep track with the value creation, we expect the stock price to do better. In this particular instance, it's done a little bit better, but that's only because we had the last few months of this year. But it tracks pretty closely, and so that's helpful. What we really bet on for the overall portfolio is that for each, well, not for every stock because we make mistakes, but that for the majority of stocks, we see a stock price performance that outperforms the value creation. And so what you can see here is for every single stock that we've held for more than, I think, 6 months, in our portfolio, what we show annualized numbers, it's a scatter plot of the horizontal axis, the value creation that I just showed before for Andritz. And Andritz is here in the red circle. And on the other hand, total return. And in a perfect world, every company in our portfolio will be up here, so higher value creation higher stock performance relative to value creation. The good news is, from a portfolio perspective, that the majority of our companies actually did create value, so they're here on the right-hand side of the horizontal axis. In terms of the future, what's also interesting is that there's still a lot of potential for these stocks, all of these here, to move up into this particular area and to catch up with what we think is their actual inner value or fair value. So, Georg earlier showed the chart where forward returns based on the valuations of components of the stock market, irrespective of the origin, but in the US, how that subsequently led to attractive returns for value. We found something quite similar for our portfolio. So what do I show here? The line with the dots is the net asset value of our fund for the last 25 years, overlaid with these bubbles reflecting valuation relative to the aggregate fair value of all of our companies in the portfolio. So if you're green, then the relative valuation was actually the aggregated value of the portfolio was below 55% of the fair value that we estimate. So what's happened is, typically, whenever we were down here, subsequent performance was very strong. Sometimes it took a bit longer, but typically we have found in the data that having a high discount to intrinsic value for our fund also meant, both in absolute terms and relative to the market, very strong performance. So we certainly, and we have our money invested in our fund, we believe that it's a very opportune time for value investing. More recently, this is since the beginning of the year, performance has actually been very strong. That's already started in September last year. So we're comforted by that. But we think that there's still a lot of gas in the tank, in as much as that valuations remain very attractive. How and when, we don't know, but certainly over the long term, we remain very sanguine. So with that, that's our formal remarks. Couple more things. We think that investor communication is very important. So there are regular events that we hold where we can exchange views with our clients. One of them is coming up in just a month in the Beau Lac in Zurich. We, together with Quantex, Julius Baer, and SIA, another value manager, are inviting everyone really who is interested for a morning of conversations on value investing. There are company presentations as well. And then for those interested, you're very welcome to come and visit us in Wielen in September. We still have to fix the date, but we'll gladly inform you via email or our website or LinkedIn. And then always in January, we hold annual presentations of our funds where we talk about what we do. And then I should also say that you might have noticed downstairs there's a big sausage stand where you can get both vegetarian and regular sausages at a discounted price. Our idea there was to offer them at 40% discount, just as you can buy companies at 40% discount in our portfolio. If you're interested in that for your lunch, come to our stand. We have these, I don't know how you call them in English, Bierdeckel. Bierdeckel that you can come and get. We'll beer lids. Yeah, that sounds right. Coaster, there you go. Thank you. We have these coasters that you can collect, and we offer them to you for a discounted sausage for lunch. With that, I thank you for your interest, and we are very glad to take any questions that you might have or comments. Certainly, we're also happy to talk to you downstairs later on. There's a microphone, yes, thank you.
Thank you very much. Would you please elaborate how you go about a stock which really underperforms in the portfolio?
Which what?
A stock that really underperforms?
Underperforms? What's really underperforming?
Oh, sorry, that is going to have a big negative return.
Over how much time?
Would you please define how you go about it?
Yeah, sure, okay. No, I don't want to give you a hard time, but the first question when a stock does terribly, so as a stock drops sharply, is we say, we try to figure out why, and whether or not that affects the intrinsic value that we've calculated for the company. So if the intrinsic value was here and the share was there, and it does one of these, then the analyst in charge has to go through the file and say, okay, well, the intrinsic value now is whatever it is. If it turns out that the intrinsic value is actually lower and the stock price is maybe not so cheap anymore, then we would sell. Because the thing that we always look at is, where is the share price relative to our estimate of the intrinsic value? We don't care about the history. That's not important. What matters to us is, where do we stand today looking forward? So if the answer is we need to sell, we sell. Usually what happens, though, is the stock price goes down. If we have to take down the intrinsic value, then we say, well, it's still cheap. We would probably buy it now today if it's cheap enough. So we'll wait and try and we'll wait and because we expect that over time these will go back together. Sometimes we buy more. It's always the first question. It's come down a lot. Do I need to buy more? We'll do that. We'll double up or whatever, add to the position. We tend not to sell so much just because normally the discount has not narrowed when this happens. Normally it's widened. So because we have time on our side, and one of the reasons that value works is also time arbitrage. We can afford to wait longer than other people because we don't have, we're not benchmarked by the end of the quarter or the year by anyone. So we'll say, okay, well then we'll just wait. How long? The problem really is this: forget what the stock price does. It's if the intrinsic value never goes up. But we've waited I can think of one stock where we've waited 15 years. We still own it. We still own it, yeah, because we always see the potential in it, and it never hits. I still see the potential in it, but it hasn't gone up. You know, it's done this. So I would still buy it today because the discount's big enough. In fact, it's actually gotten quite interesting.
So when you buy because according to your computation, it is discounted at least 40%.
Yes.
And then assuming there was a misinformation in the initial intrinsic value computation, it's going to come out that actually the discount you bought it at is 20% and not the initial company motto 40%. So you are at minus 20%. So what do? You still believe that, okay, I bought it a bit more expensive than where I actually like to do it,
yeah.
But because I'm still at discount versus to the computed intrinsic value, I will wait for the two values to merge.
Right. In a sense, what we're saying is we forget the history. For the buy and sell decision, the history of how you got to the current situation isn't relevant. What matters is the discount. Now, that doesn't mean we don't pay attention. We actually have a lot of focus on where the mistake was in the intrinsic value computation. Is that something we should have seen before? What can we do to avoid that mistake? But the mistake having been made, you know, the milk having been spilled, if you will, the point isn't who spilled the milk or why spilled it. The point is, let's get the milk off the floor. And so that's the way we look forward. We say, okay, but it's so cheap now that we're going to buy more. And then if we see, or not, and if this,
go ahead.
If the stock, of course, if it keeps doing this and we're consistently wrong, at some point we do say, okay, we don't understand this thing, we're just wrong all the time, and then we sell. But
I might just add, because you said specifically 20%, and that's an interesting number because some of it is also relative to other opportunities that we both have or might find in the market. So if, say, the spread has been compressed down to 20%, and typically we find plenty of opportunities where the spread is higher, then we might trade out. So it's not just on an absolute basis, the overall portfolio composition really matters too.
Yeah. And we tend to be early. We tend to, you know, our worst performing stock right now is something that we bought recently. It's been coming down a lot. We still think it's a wonderful investment case and all that kind of stuff, but it's been a terrible performer.
So you buy?
Yeah, we buy more. You know, we have certain limits. We don't commit endless amounts of capital to the same idea. Otherwise, it sucks up the whole fund. But yeah, we add to the position.
It's also really important to have stable capital and investors. So it helps that we ourselves are big investors in the fund. It also helps that we have a 25-year history, because this is difficult to do if assets come up and down at very rapid clips.
It always comes back to the same question. If we were rich enough to buy the company, what's it worth to us? At a bad quarter, doesn't necessarily reduce the intrinsic value of the company. You know, you can have bad quarters for a number of reasons. So,
thank you for the question. Are there any more questions? Yeah,
please
go ahead.
So there is on the last slide where you presented global. Yeah, exactly. So what's the difference between global equity and value equity?
Yeah, so we have two funds. One of them is the 25-year running fund that effectively is different from the other in that it can buy even very small companies, whereas the classic value fund is restricted to companies above 2 billion in market cap. So it's a bit more liquid. The value equity fund is traded or priced daily. The other one's priced weekly. So there are structural differences. Otherwise, same investment approach and universe. Oh, yes.
Yeah.
Thank you. That's forward-looking, yeah.
Yeah.
That's wishful thinking.
This is not a performance promise, or not a promise of future performance. Just let me add that disclaimer.
Let me go to the disclaimer now. So there you go. Thank you. Well, thank you very much. Again, please come by and talk to us later at the stand, and have a good day.